I think the marketplace has changed a lot. I mean, before the COVID or in the early stages of COVID, interest rates were super low. The cost of money was very, very low. So people, the hurdle rate, it's not really an issue. People are able to lend you a very long-term money because the cost is so low, hoping for the final return. But now there's an actual cost because interest rates are much higher. And because the interest rate scenario has changed, and maybe it has changed permanently, we're not going to go back to where it was before, because inflation is here to stay. The financing is going to get harder.
Welcome to Let's Talk C Business Podcast. I'm your host, Reggie, aka your Chief Financial Coconut, and I'm joined with my favorite co-host,
Wei Yuan. Almost missed the cue.
For people that don't know you, you want to introduce yourself?
Yeah, so I'm Wei Yuan. I've been in startup my entire career. My first startup was in 2012 in my second year of uni. So I literally have not worked for anything other than startups. I did that for 8 years. Started the business in Singapore, going to Southeast Asia, landed some clients around the world. And basically was a generalist in running from sales all the way to ops and delivery. Right now, I'm the head of sales for Singapore, primarily at Glintz.
Yeah, we have a great guest in studio. Today, we're going to talk a little bit about all the money things around business, right? So would you like to introduce yourself?
Hi, everyone. My name is Boon. I work for Maybank Singapore. I look after the commercial banking division. So that's the non-retail side of banking. So we give out loans, anything up to 100 million from 500,000. So in our line of business, we have 3 segments. The very small SMEs where we loan up to $2 million. We have the mid-size where the loan got up to 10 million. And then above that is what we call business banking, which is 10 million up to about 120 million of loan size. So that's our primary business, giving out loans, but we also provide a lot of other services like trade, insurance, cash, treasury, so FX needs, hedging, for example. So we have a wide suite of products. So I look after a team of about 100 RMs in Singapore, and we cater to all businesses. I mean, most of our clients are from Singapore, but we do have a fair share of customers from overseas as well, because Maybank is present in all the ASEAN countries. So we do have people coming in, being referred into Singapore, and vice versa, being referred out. So essentially, that's what I do. I've been with Maybank for 11 years and hopefully more.
Yeah.
Wow.
Different generation. 11 years does not sound like a lot.
I was mine at 8 so
11 years for a startup is forever, right?
Yeah. Fair. Yeah.
10x speed.
I think so. Yeah. Okay, so that's great. And I think to set the stage, right? Most of our audience are mature SMEs, trying to expand beyond the region. And of course, within the region, and also we have some business leaders that will tune in. So with that as a background, right, I think we can kind of talk a little bit about as we scale as a business, right? Some of these financing requirements and some of these like ins and outs when people try to understand this. How does it kind of come along within the landscape of commercial banking?
Yeah, so essentially when people start out, they'll pull their own money, their friends and family. But as the business grows, they realize there's a financing need. They need extra capital, right? That's when they approach a bank or other financial institution to take a loan. And from there, if they are able to grow the business, then the loan size gets bigger. So it's a very natural evolution. So in the most basic form, a loan is what you need. But as you grow bigger, if you go overseas, for example, then other services like trade financing becomes very important. FX needs becomes very important. So the complication grows as your business gets larger. So it's a natural state of events.
Fair. So if that's the case, right, then as a business grow to that level, I mean, other than scaling up their loan quantum, right, which is kind of natural, right? You're talking a little bit about this FX suite management, all these some of these other things, right? Which I think it's where the complexity start to come in.
Yeah.
Right. How should kind of SME bosses at that stage think about this? Right. When they start their businesses in Indonesia, Thailand, then they have to manage this whole FX in and out and all that stuff, right? So how would they think about it?
So I think understanding your primary business is very important, where your source of revenue is. So if you're getting your revenue just from one country, then taking a loan in the same currency, I think is very important. So you avoid the FX risk. Then you don't have to worry about FX hedging, for example. But if you are doing multiple business in different countries, then that risk obviously goes up. then what you need to do is actually speak to a bank where there are treasury specialists, and they're able to advise you better on your requirements. Right? Because we want our customers to avoid is taking on unnecessary currency risk. You borrow Sing dollar, and then you get your revenue from ringgit or Indonesian rupiah. We all know that the currency fluctuations can be very, very big from time to time. And if it moves against you, the revenue that you need to earn becomes a lot more to pay your loan back home. So that's something that I think people need to understand when they go cross-border. And that's where some of the hedging comes through, because you can hedge partial, you can hedge full, you can hedge before your money comes in, for example.
I want to know all about that.
Yeah.
Can you share with us? Because even at my scale of business, right, we have about 10 men, and then I already started all these weird currencies. They're not weird, right? So Sing dollar, US dollar, ringgit, but by a much smaller scale. So even this sometimes is a little bit of a like kind of loss about this, right?
Yeah.
So when you talk about this whole like hedging at different level, how does it work? Yeah.
So understanding the currency pair is very important. So very obviously the the US dollar is pegged to Hong Kong dollar, for example, so that pairing doesn't really change. So you can take one currency and invest in the other one. It's not going to be an issue. Everyone knows that Sing dollar is pegged to a basket of currency, and US dollar is one of the major components, right? So it's quite stable against the US dollars. But if you look at other regional currencies like the ringgit or the rupiah, then it becomes a lot more volatile. So we've seen people taking loans simply because of the interest rates, because interest rate scenarios are very different in different countries, right? So if they want a cheaper loan, they might go to Singapore, then they go to invest it in Indonesia and Malaysia. But over time, as the ringgit weakens or rupiah weakens, they find it's a problem repaying the Singapore dollar loan. So they got to be very aware of this risk and try to avoid that. So this is something you can learn through experience, lose a lot of money along the way, become smarter, or you speak to a bank that's able to advise you, who have seen this across multiple cycles. And then we have FX research in Maybank as well, for example, and then we can sort of predict or estimate where the currencies are going to land in 12 months, 24 months. They'll give you some idea on how to manage this risk, because if you don't manage it, I think a lot of hard work can be taken away just from the currency side.
Of course.
I think one thing that occurs to me, because in my own journey as a business owner, right, of course, aside from understanding the technicalities that you just mentioned, right, one of the gaps that we have is that we don't even know, like, finance is like this big, iffy, scary subject.
Really?
Right? It is for me. I come from SMU, but finance is my weaker subject. And I wouldn't know how to approach or who to approach to understand these things. Right? And so that is like already a learning curve blocker.
Yeah.
To accessing the institutional knowledge about these things. I wouldn't know who to go to, who do I speak to, who do I ask for, to go to the bank to understand these things, right?
Yeah.
So how can SMEs cross this like knowledge chasm?
So in Singapore, for the very small SMEs, for example, they use a lot of loan brokers. So we have a very active pool of brokers who are out there canvassing, the small companies, offering their services to help them get cheap loans or the cheapest loan possible. Because if we are a startup, a 2%, a 3%, or 4% running a small business, you're fully focused on getting a business right.
Yeah.
The finance part may not be your strongest point.
Yeah.
Right? How to approach the loan, what it takes, the documentation that's required, how to repay. It takes another level of research which not everyone may have. So we've seen brokers coming into the space to help the small SMEs. So that will help. But if you go to a mid-size or large size, then clearly you need someone who is
exactly
very good in numbers, who is crunching, knowing what the income is coming through, taking into account the seasonality, the competition, and knowing how much interest you need to pay, and all the other expenses. So I don't think you can run the business without knowing your cash flow well. I think that's
exactly
a fundamental thing.
Of course.
New startup is about getting the business model right.
Yeah.
But once you want to scale and grow bigger, then I think the cash flow part becomes very important in managing your asset and liability.
For sure. And I think that is at some point when you get big enough, right, then you have an attached banker. The banker will scale with you. That's usually how it works.
That's what we try to do in Maybank as well. We try to partner the small companies from a very early stage, and we help them to grow along the way. As I explained earlier, we do give out loans 500,000 to $1 million, and then as they grow bigger, we go up to 10 million, and then they grow up to 100 million, 200 million, for example. If you go beyond that, we have a global banking team that's able to grow, give out even much bigger loans. So that journey is something that we want to partner with our customers, and is a learning experience for customers as well.
For sure. And I think when a lot of businesses try to grow with loans, right, people are always seeking for the cheapest one in the market. Right. So there's a general tendency. Is that a first rule of thumb? Or is that a rule of thumb? Or are there other considerations when kind of going to leverage their credit?
I think it's fair to look at pricing, but you also need to look at the people and the service behind it. Because, for example, the cheapest loan may just come from a company that only operates in Singapore. But if you have plans to go overseas, then you might want to look for another bank that's able to provide you with more service regionally. I think digital services is now getting very important. If someone is just able to offer you a loan with nothing on the digital front, you're going to be very handicapped as well. So I think there are several other considerations besides price point, right? The service behind it and the digital capability, and then the footprint around the region.
Okay. Yeah, actually, I want to ask more about the whole FX management thing. I feel like that's the crux, the complexity problem is that loan quantum is so simple, right? Like if you're a seasoned business person, you just kind of work through this, right?
Yeah.
But managing this FX problem, right, it becomes increasingly a consideration because, like you said, there's some sort of forecasting element to that.
Correct.
Right? And then when do you kind of manage this risk? And as you manage more risk, then your premium moves up, right? So this whole structure, how do you think about this?
Yeah, so in the basic form, you want to match your loan with your revenue. Like same currency, avoid the risk.
Okay.
But if you cannot do that, you want to take one currency to fund another business, another revenue, give yourself a bigger buffer.
Okay.
Right?
What does that look like?
So instead of earmarking 60% or 50% for your loan repayment, you might want to earmark 70% for your loan repayment. So that the currency moves against you, you have a bit of room to weather the storm. Right? During the financial crisis many years back, one of the biggest issues for companies in Thailand, Indonesia, Malaysia is that the currency weakened considerably against the US dollars.
Yeah.
Prior to that, before the Asian financial crisis, currencies were pegged. So people were very confident. And they were just looking at interest rates without taking into consideration the currency risk.
Yeah.
When the currency depegged and the currency's value dropped and they had to repay back into the more expensive loan, that's when a lot of people went bankrupt. So match the currency risk if you cannot give yourself a bigger buffer. So I think that's a safety rule that we can advise. If not, just take a loan locally. Take a loan in Malaysia if your revenue is there. If you have another business in Indonesia, do the same. Take a loan in Indonesian rupiah. So you sort of match that risk. But if you have multiple businesses going and you are decent size, then you can look at it, put it together, and then try and do some simulation and forecast. That will obviously require a lot more skill.
But Richard, could you add a little bit more flavor as to what kind of challenges you face on the FX side of things, so we can understand a little bit more use case wise, what is it you're trying to tackle?
You mean me?
Yeah.
Oh. I think he pointed out essentially you take the loan from the home currency, you leverage, and then the asset is pegged to the same currency, mitigate the FX risk, right? So that's simple. But I think a lot of let's say Singaporean mature businesses, right? They think how about I borrow in Sing dollar?
Yeah.
The rates may be better, right? And most of your assetral backing is all here, right? You own this shop house, you own that thing, you can use it to negotiate a better rate, right? So there's a lot of those things that come into play. So the thought process could be, okay, we'll take in Sing dollar and then we'll invest abroad.
No, I think you touched on a very good point. Because if you operate in Singapore, you have a track record. 5 years, 6 years, you're able to give you a loan. If you move to another country, you're brand new. No one knows you. Right? You don't have a track record. So what do? Then you go to a bank with a regional presence. So what we do for our customers, for example, we give a reference letter. We give their credit history so that our counterparts in the other countries know their repayment is good, their credit history is good, then the comfort is there. Sometimes your assets, like your building or your business or machinery in Singapore, you can pledge those assets to take a loan, and also it's more viable. So those are some of the things we look at when we help customers.
Fair. So then, what are some of the strategies then? Like you're saying, like, okay, so I get the plain vanilla strategy, right?
Yeah,
So I totally understand. I think our listener pool kind of get it, right? The plain vanilla strategy, borrow in the same currency, have some sort of a forecast, manage a buffer, right? So I think those things are okay. But in terms of the more interesting, how do you manage this risk? How do you do that?
So one of the things I want to bring up is
Don't go for interesting things.
no, is to make sure that your credit repayment history is positive.
Okay.
It's very important, your track record, right? Because the banks will look at it. So on a personal basis, we have a CBAS record. Before you apply for a credit card, before you apply for a loan, the banks will look at it to see, what's your rating is. Are you A, a B, a C, or E, whether you've been defaulting. So in other countries, there's a corporate bureau. So they look at the lines that you've taken with other banks and whether you defaulted or not.
Yeah.
The better your credit history is, the lower the cost of borrowing. So it's an advantage to you. So sometimes people say, this time maybe I'll just skip one or two payments, drag the payment longer a bit, improve my cash flow, or use the money and do something, go for a holiday if you're a personal business owner. But all this will be reflected. The banks will know.
Yeah.
Once you have a history of missing payments and all that, it will affect your subsequent ability to borrow or even gear out.
Yeah.
And we charge more for bad borrowers. That's a fact.
Yeah.
Yeah. Right?
What's the variance?
It can be quite high. It can be 3%, 4%.
Oh, that's a big variance.
Yeah, it's to reflect the risk. I mean, if you miss your credit card payment, it's 24%, right?
Okay.
I've never gone about what I say.
So
then, how's you?
You can't take a loan from us and they go to private lenders. They pay 2-3% a month.
Of course.
Wow.
I mean, that's substantial.
Yeah.
So once a door to a FI is closed, your avenues becomes very expensive.
Yeah.
Right? That's where the loan shark comes in.
Yeah.
For personal borrowers, you want to avoid that.
Yeah.
Of course.
But does that mean that, like, for businesses who don't have a track record of borrowing, right, then their credit lines, their credit history is not substantial? Does it mean they will face challenges getting loans from others?
So for those cases, we normally start small. Right? We extend a small line to test your history, to look at your ability to manage the business. Of course, there has to be a personal guarantee. So if it goes bust, we'll go after your personal assets.
I look for you.
Right? Otherwise, if you have personal assets, for example, if you have a house, you can take a loan against it. We have equity term loan. If your house has LTV, loan to value about 40%, you can gear up.
Yep.
Take out part of it as some money to invest.
Yep.
That will form as a security for the bank. So we have something to fall back on if you miss your payments. So starting out small is not easy because you don't have a track record. But if you're able to pull through and make the payments regularly, then I think the confidence will grow with you.
Of course.
If you don't mind me going along this track a little bit more, right, it's because, like, even for like a company like Glint, we are Series D, I think to date, last round was like 50 mil USD, right? Our traditional financing is VC backed.
Yep.
Right. I don't think we really think about that financing.
Yeah.
Right. So is it in the favor of like companies even of this size or larger, right, to even think strategically to start borrowing to some degree to kind of make that ease of borrowing easier in the future if they do need it?
Yeah.
No, I mean, my view, okay? My view is if you're burning cash for growth, don't do it, right? Because you have no stable cash flow to fundamentally manage this repayment process. That's why when the interest rates move up and the easy credit disappear in the market, all the startup crash, right? I cannot say all right? But whoever survive, most of them will close shop, right? Because they got not enough money to burn, right? But what is your view?
Okay, so a viable business and the venture capital is very different.
Fundamentally different.
A viable business means that you have a
Stable
track record,
cash flow,
you're making money. Okay, that's a key bottom line. A venture capital means that you're trying to grow your business model, try to prove it, trying to scale it up. So you may not be making money. Like Amazon in its early days, for example, they are burning through cash. Tesla at early days are burning through cash. They are trying to build up to a certain scale. So the kind of risk, that's not something an FI would take.
Oh, so even you don't want to take, not that whether they want to loan.
Yeah, correct. It's a very different form of risk because, the payback as an investor, because you're investing as an equity.
Yeah.
It could be 50 times versus what you put in.
Yeah.
So the risk reward is there. You can put in 10 investments, hope that two goes right, and you pay off the other 8.
Yeah.
But the bank will don't operate in that manner. So it's a very different model, which is why in the marketplace, you have financing coming from different people in very different forms. Ours is a loan, it's a debt.
Yeah.
What you're talking about is equity financing.
Yes.
Yeah.
Skin in the game where ultimately if you go listing, that's where, great, all
Your
the payment
returns.
comes
Yeah.
through.
Yeah.
No, but I think the converse is interesting. A lot of tauques, they don't explore equity financing.
Yeah, exactly.
Right, so they could totally split up some of their businesses, structure it, and then run equity financing.
Yeah.
Front load 300 million, and then you roll from there, right? I mean, I think Singtel did some interesting things recently with KKR or something like that.
Yeah.
So there are all these other interesting things that people can do, vice versa.
Yeah.
Right? Yeah.
But you lose control.
Of
Yeah.
course. Yeah. Then
You take a loan, you're still in control. You can control the business direction. You can make decisions. Once you have a venture capital, you have to report.
Yeah, answer to
Share.
new bosses.
Of course. Yeah, of course.
You have to meet certain milestones.
Yeah.
So it's a very different journey.
Yeah.
Ultimately, it's about what you want to achieve and where you want to be.
I'm sure.
Because if you think your model it's very scalable and you have a very, very long term outcome that you're looking for, then venture capital is one you want to go for.
Yeah.
Because you're going for a big return.
Yeah.
But if you're taking a small loan, then you're going for a slow and steady growth.
Yeah.
Mm.
Also,
Different game.
yeah.
Right? Yeah.
different horses for different horses.
Wow, nice.
Yeah.
Nice soundbite. Just looked in the camera.
Different horses for different horses.
Awesome. Yeah, I mean, like, so this is just a reflection on my end.
Yeah.
Because like right now the venture scene is very cautious, right? In fact, a lot of VCs now look at profitability as well.
Yes.
Right, I am the subject of the scrutiny right now, having to focus very much on
Carry the KPI.
operating profit as opposed to
Yes.
growth, right?
Market share.
And I think just for our listeners out there, like, just wanted to get some like visibility over here. If debt financing is something that they should start thinking about potentially. If they are building towards path to profitability as opposed to like 10x like growth at the top line.
Yeah. I think the marketplace has changed a lot. I mean, before the COVID or in the early stages of COVID, interest rates were super low. The cost of money was very, very low. So people, the hurdle rate, it's not really an issue. People are able to lend you a very long-term money because the cost is so low, hoping for the final return. But now there's a natural cost because interest rates are much higher. And because the interest rate scenario has changed, and maybe it has changed permanently, we're not going to go back to where it was before, because inflation is here to stay. The financing is going to get harder. So I think in the venture space, if you already have skill, you're ahead, I think you have a very good chance of pulling through because the competition is not going to be a lot more intense. But if you're a new startup now, clearly the hurdles are a lot more than ever before.
It's hard, man.
Because you need to make profit to return the money. Whoever gives you the money, invest the money, they want to see a much higher rate of return because there's a cost to it.
Yeah.
For sure.
Cool.
Let's Talk See Business is brought to you by Glint's Talent Hub. We understand that building a thriving business is immensely challenging. It is especially intense for business leaders like yourself. Hence, we want to journey with you. Glint's Talent Hub is the leading all-in-one solution for all your talent needs. Our mission is to pair you with the right talent anywhere across Southeast Asia that fits the unique needs of your business. From there, we handle all your talent management needs. We're talking talent sourcing, hiring, EOR, PEO, talent development. We have a track record of 2x faster team building and up to 70% cost savings. If you want to expand in Southeast Asia, we are your partners. Connect with us, link in the description below.
Yeah, and talking about the cost of borrowing, right? Can you give us some thought process around like how do I bring down my cost of borrowing? How do I come to you and say give me a better rate, right? Other than a good credit record, right? I keep paying my loans. How do I come to you and you give me this person can give preferential better rate? Yeah.
If you have assets, I think that will help because then the bank has some form of security. If you have no asset, then
What would consider an asset actually?
a property or some deposits that you can pledge, or some personal guarantees from other people. Because in the absence of that, then it's really dependent on you. It's what we call a clean line. We give you a business term loan, hoping or working capital, hoping that you can repay us on a regular basis. So pricing is a subject of competition as well because it's a very competitive space. But as I mentioned earlier, pricing also will reflect the risk that the bank is taking in giving out that loan. Yeah, so in a way, if all things being equal, the pricing shouldn't differ a lot. But once you have assets, if you're able to take up different product and services as you get bigger, then the pricing can vary.
Is there a variance to the quality of asset backing?
Oh yeah. I mean, disposability is a big consideration.
Yeah. So how do I think about it? Right, because Singapore, a lot of SMEs will have some property here and there, right? At that size, but actually property in relatively illiquid in the market. Right?
I mean, generally what we see is like commercial property, it's more liquid and more and easier to dispose. Industrial property in far-flung places, for example, is much harder, especially with a small unit or there's a lot of similar types. So commercial definitely is more viable than industrial. So there's a primary rule. If you pledge your residential, then clearly it's also very liquid, then we can lend you more. But I mean, we would hate the day that we have to take the home away from it. It's going to be a very tough conversation.
Okay.
Yeah.
Are there other interesting things that people pledge with? Like, what about intellectual property? What about machineries?
I mean, it's about the disposability. I mean, intellectual property is very hard to value, right?
So from a bank's point of view, it's very hard to give you a loan based on that.
Yeah, so even if you give me a car, your LTV is not really very high.
Yeah.
How will depreciate too?
Yeah, so fast.
Right, for example. So it's difficult.
Okay.
We do have customers on the hire purchase side where their assets are all fleets of cars and trucks and all that. So that's fine because we have the skill and they do have a track record and it's their primary business. But if you are in F&B and you want to pledge your car, so there's no easy way. So you have to start small, build up your track record, build up to a certain scale, and then we take it from there.
Okay, interesting. What about things like trade financing? Right, where people come to you with some sort of like an order list of something, like people are going to do a big project down the road. They clinch a deal and then they come here for financing. Yeah. Right? How does that kind of work, and what is the kind of rates that we're looking at?
So the rates could anywhere between 7 to 8%. So depending on the size as well. So there's something that we actively do in Maybank too, because there's a lot of cross-border flows, a lot of import and export of businesses. So a lot of customers are exposed to such things, and because they want to make sure that the money flow is in their favor, they want to make sure that they get the money when they export. So that's where the trade financing comes in. So it gives them an added layer of security.
In what sense, the security? Like for some of our listeners that they got to a certain size and they're suddenly exploring some of these things, right? How does it fit into security? Is it a cash flow thing?
It's a cash flow thing. There's also where the goods are exported and how it's being exported. So if you want to make sure that the goods get to the end state, someone is able to cite it, and then before they release the money, so you got to work with another bank.
Okay.
So this is a bit of a divergence from kind of like the direction we're going on, but like some glimpses in the cross-border business.
Wait, before you diverge,
yes,
ask one more.
Yeah, sure, go ahead.
Yeah. Because okay. So what about things like revolver, right? I think revolvers are not as trendy amongst like the smaller businesses, but as businesses get bigger, I think revolvers become very interesting as part of their growth allocation type of methodology, right? So how does that work?
So a revolving line is what we call a standby line. It's for customers to draw down when they need. So on a personal basis, you have your credit lines and from credit facilities. You use your credit cards, or you have maybe a 10,000 or 15,000 loan. If you needed to draw it down, you get money, you pay it back, but the line is still there. So this is for unforeseen circumstances, for times when maybe the business is very good, you need to import more goods, buy more services and all that, then you use a revolver. Yeah.
At what stage can I explore something like that? Or you will just offer me, because you see I got a lot of float inside, then you'll be like, hey, you want revolver?
I think the small revolving line is never an issue.
Okay.
Yeah. So the revolving line is what we call a clean line. The clean is a risk to the bank. So like in Maybank, if you have a property, we can give you a line to lend against the property, and whatever excess that is not pledged, we can give you a working capital against it.
Okay. That's cool.
Yeah. Okay. So so saying Glintz is in a cross-border business, right? So one of the things we deal with a lot of is FX. Right? We operate in like Indonesia, Vietnam, Thailand, Taiwan. some of the countries in South Asia, right? So we manage the salaries of a lot of employees in those spaces.
Yeah.
And I think one of the things that we are grappling with, right, is building an in-house like finance team that can manage this extremely well.
Yeah.
So do you have any advice for, companies that are starting to do that, right? How should they structure? What's the ideal team structure for financial agility, right? For operating in like multiple countries at the same time?
I think there are systems in place out there, software like payroll system that you can use. So one of the initiatives that Maybank is using is accounting and payroll software that we want to provide to our customers. So we're tying up with some providers so that SME come in exactly like you said. Once they grow up to a certain size, they need all the services. They need all this software that's able to automate and calculate and account for it. So when it comes to filing for your financial statements at the end of the year, it becomes a lot easier. It's pretty much like your Excel in the most simplest form, right?
Yeah.
So it helps you with the planning and your timing of the cash flow. So there are apps available, there are softwares available, then do think about that.
So there's no methodology around this thing.
It's okay. So payroll is a regular.
That's exactly
expense.
the one that we are.
Yeah, it's recurring, right?
Yeah.
So when it comes to business, you have regular recurring expenses, and you also have longer term expenses you need to incur, like your investments, your CapEx, and all that.
Yeah.
So when it comes to cash flow, you want to make sure that your recurring costs are taken care of, but you also need to budget for that one big lump sum where you need to buy a machinery or renovate your kitchen or renovate your shop house or move to another location.
Yeah.
So cash flow planning, if you look at that, you gotta cater for that. Besides providing a buffer for emergency situations.
If I just go down this rabbit hole a little bit more, right? Because you mentioned payroll, like regular like payout and stuff like that. So like for example, Glintz, you manage like thousands of employees or salaries because like our model basically is you hire through us, they are parked under our entity, but they work for you.
Okay.
So, but then like for example, Indonesia, right? The payroll regulations change every year. Well, like for example, if you are married, if you have 1 or 2 kids or 3 kids, your age, all these factors into your tax like brackets.
Okay.
And like your different like social security requirements, right?
Yeah.
And the calculation is extremely complex.
Okay.
And after a while, it becomes very unwieldy if you're doing it manually. Right, which I assume a lot of businesses go into starting like that, right? You employ somebody, you just use Excel, and then you try to keep up with the times and try to implement it at the right time. And then when you scale it to 1,000 employees with like maybe 3 or 4 headcount managing it, does everybody do it consistently? Some do it inaccurately. So that's a challenge. Do you have any advice around building a good system around this for accuracy?
I wouldn't be able to provide advice in that, but I would imagine there'll be accounting firms that can help with that to deal with the complexity and all, because taxation differs in different countries. So as they change, you need local expertise and advice to be able to help you navigate. I don't think there's the one size fits all or one system that can help you. Negate or mitigate all of these challenges at the same time.
That's why you are the expert, ma?
Yeah.
Right?
Exactly,
Right.
If it's a common problem, then I think people would be able to find some form of professional help to help.
Yeah, for sure.
Maybe it's a form of job creation. Right?
Yeah.
You create ancillary services by changing all these rules.
Yeah. Fair.
We don't know, but
Yeah. Okay. Yeah, I'm actually quite interested in this whole float management type of situation, right? So essentially, we assume our listeners have business is strong, they expand abroad, they go good cash flow, right?
Yeah.
So other crazy things start to come in, right? So maybe we can do this, maybe we can do that, right? So there are a lot of interesting things that people can do with that kind of cash flow, right? And I know it's very common amongst the finance guys to try to convince this SME tauke, right? Never mind, you put some of your float here, and then you try to generate some yield while you wait out for the next thing that you're doing. Right. So what are some interesting things that you guys would recommend SME bosses?
So if you're just looking to enhance yield, I mean, obviously you look at time deposit, you look at money market funds where it's very liquid, you put in, it pays you a much better rate than CASA, for example. You have a longer time horizon, you would buy a bond. But if you are a 1 or 2 person startup, you want to buy a key man insurance. So that if anything happens to you, there's a payout. It protects the business. It keeps the business going. If there's a departure of a partner, for example, you might get some money back, and then you can find a way to keep the business going while you find other forms of expertise to come in. So if you have money to spare, those are the things to look at. But I think key man insurance is very important, especially for a small startup, because if you are two men, just like the two of you work together, and one of you something happens, then what happens, right?
Yeah.
If there's money that's paid out, then at least you can keep the business going. You can think of alternatives. You can hire professional services and all that.
How does that look like? How do I negotiate with you a key man insurance?
So either you pay cash up front, a lump sum payment, or you take financing from the bank. So you pay maybe 20% or 30% down payment, and the rest is in a form of a loan. Yeah. So if there's a key man insurance, sometimes the cost of borrowing might be lower as a result too.
Okay, help me understand a little bit more. So essentially, you merge a loan product and the insurance product into one product.
What we call a single premium whole life or key man insurance. This is a common product in the marketplace, right? So rather, instead of a regular payment, you pay part of it upfront in installment. So why you do that? So that you can take a bigger a bigger premium quantum, a bigger coverage, and then you pay the installment over multiple years, broken down into a monthly, semi-annual.
Oh, it's the first time hearing.
Oh, no.
It's interesting. Our business is not that big yet, so but it is.
So the other thing that what people do when there's extra money, of course, they take the money out and invest in something else, right? So they invest in other ventures, or they pay out. If they're a company, they do a dividend payout to themselves or their family members.
Of course, but those are basic, right? Those are like quite plain vanilla amongst the entrepreneur community, right? It's the type of how do you engineer some financial strategies into that buffer that
so
is
if
interesting.
you want to grow, then obviously you look at acquisition targets. Maybe you look at a competitor someone is doing well. Maybe you look at the chain of businesses. If you are in F&B, you might want to buy a supplier, food supplier, for
Particularly
example, to reduce the cost.
The value chain.
Or you integrate the system. So that you create an entire series of chain, right? So you don't lose value along the way, because if you are only one part of a ecosystem, other people are just making profits along the way, right? So sometimes when you look at a business, you got also look at what we call verticals, where the value is, and maybe perhaps go into that rather than do the business. So if you're F&B and you're paying money to a landlord, maybe you want to be a landlord rather than be an F&B business, right? If your business is doing well, then buy the shop house instead, and rather than run the F&B, because you're working for somebody else, and that's where the value is. And also, so these are something to think about. And also the channels as well. If you are in the offline channel, you want to think about online channel, diversifying your revenue stream. So we've seen during COVID, those who are able to pivot very quickly to online are the ones that survive. If you don't, because no one is able to move. No one's able to go to visit the shop. So I think that channel diversification is very important too.
Okay. Anything of that?
I think pretty much
covered. So I think you've covered a lot of good stuff, right? I'm sure individual products we can go much deeper, if we have time. But just to kind of sum it up, right, for our audience, right? Because there are varying factors into determining a loan quantum, right? Your credit ratings, your credit score, and then there's the asset backing, and then of course there's the timeline and creditworthiness, right? All those things, right? But when I'm thinking of growing a business and I want to take a loan, right, is there some sort of a reference number that I can base off? Is it my cash flow times 20? Or my cash times how much? Like how
a multiplier.
Yeah, a multiplier. Is there like a multiplier for reference, so that I base on my current business today? I have a good sense of okay, I can loan up this quantum at this margin. From here I can invest. I have a timeline to run.
I see.
That type of thing.
So it's all a debt servicing rate.
Yeah.
Right. So
even a business has a debt servicing ratio.
We look at before we give you a loan, we'll look at your ability to repay the loan.
Okay.
And how we judge that is based on your cash flow. Historical cash flow, how much free cash flow you're able to generate, how much of it are you able to service the loan. That will determine the loan quantum, and then.
So is there a formula there?
Yeah, it could be 1.2 times or 1.5 times of your debt servicing ratio. That means whatever you generate must be able to to more than pay by 50%. Yeah. So when you calculate that servicing ratio, we also assume that all your facilities are drawn out because you want to test your viability in times of trouble. You know, so debt servicing ratio is the most basic form for banks to gauge your ability to repay and how much you're willing to let you.
In closing, do you have any last things you want to share with our audience, like as they scale out into the region? Because you guys have regional footprint, right?
Yeah.
So like, how does it look like? You know, what are some of the risk factors that people maybe commonly they don't think about it when it comes to financing and all that, right? So
I think from what we've heard and from speaking to people, I think the regulations and the local nuances are very important. You know, if you go in there, you need to partner with someone locally who's able to help you along and navigate the rules and regulations. Like you said, the payroll challenges and all that. But if you have a bank that's able to help you with the loan and account opening, I think that'll be a first big step. We do have forums and events where we are able to partner up companies with other like-minded, you know, companies where they can assist each other. So I think that will help. But you know, I think the market is very challenging. If you look ahead of the next 2-3 years, interest rates are going to stay high. The geopolitical situation is not going to stabilize anytime soon. Things will get worse. You know, who knows with the South China Sea situation, which is very close to home. More trade disruptions could happen. So I think being conservative a little bit is not a bad thing in this uncertain times.
Okay, one last question. I know I got a lot of last question. I'm very not viable already. So, what is your FX forecast for some of the regional currencies?
So I think our forecast is for interest rates to come down in the second half of this year, maybe about 50-75 basis points. But this has been going around for a while, honestly, because inflation is still very high. A lot of people are expecting rates to come down a lot faster this year, but it hasn't happened. So the Sing dollar could stay strong. So the Sing dollar is like the gold standard compared to most economies, right? Because we have a large reserves backing it. That's why a lot of people come to it as a safe haven.
So the ringgit will bounce back now?
Well, it depends what you do with the budget deficit. So I think they are taking steps to address it. Reducing the diesel subsidy, I think, is a step in the right direction. I think if we get a fiscal situation right, then I think the ringgit should get stronger because Malaysia at the end of the day there's a lot of natural resources. There's a lot of good things going for it as well.
Nice. Okay, good. Cool. And if our audience would like to connect with you, where can they get to know you better? Is it LinkedIn?
Yeah, I'm on LinkedIn. You can look me up in Maybank. I think it's quite easy. So happy to help.
Really. Are you on Instagram?
Slide the DMs.
Slide into my DM. Okay, thank you for your time.